Good morning, my name is Jamal Khan. I'm the Head of Tax at Churchill Tax Advisors. We will be presenting our weekly tax update summary, tax case update summary. Today is the 8th of July 2019. The following cases have been announced recently by the First Year Tribunal. The first one that we're covering today is the case of Ad Hoc Property Management Limited versus HMRC. Now, this is a very interesting case on costs being claimed and awarded. So in this case, HMRC had raised assessments of £3.4 million. The appellant engaged some very expensive advisors and they put their defence forward. HMRC felt that they couldn't win, they had no chance of winning at the tribunal, so they withdrew just before the hearing. So the appellant claimed that they had incurred costs of over £500,000 and made a claim for costs. This matter was referred to the tribunal, where the tribunal judge felt that the costs were extortionate and they allowed standard costs of roughly £50,000. So the appellant was awarded roughly £50,000 and as such they lost their appeal. At the same time, the tribunal judge awarded costs to HMRC because the appellant lost his case for costs. And the appellant was left significantly out of pocket. But it goes on to say that you can claim costs, but you cannot claim extortionate costs. Second case is for Mr. Sood versus HMRC. Now, in this case, Mr. Sood had filed late returns. The matter was referred to the tribunal. However, HMRC did not make objection to the late return in the right time, the right of time for making the objections, and therefore they lost their case. The third one is Mr. Mahood versus HMRC. Once again, this case, the appellant made a late appeal. HMRC objected to the late appeal, but when it went to the tribunal, there was sufficient reasonable grounds to award the late appeal for the appellant. The next case is a very interesting one that I feel can be used in many cases where HMRC raised their assessments. Now, this is the case of Total Catering Equipment versus HMRC and has recently come out. Now, in this one, there was an appeal by the HMRC had raised assessments based on the turnover, the sales, and this included VAT, but the appellant claimed relief for bad debt based on the fact that one of the dishonest employees had been taking some of the sales. Now, HMRC didn't allow bad debt relief, but when it went to the tribunal allowed bad debt relief based on the fact that the money was taken by somebody else and it didn't end up with a business. And this case could have very large implications on other cases as well. That's where HMRC raised assessments, and there are often cases where one of the staff members or the store managers is stealing from the business. The next one is the case of Mr. Malik versus HMRC, where Mr. Malik, the case, HMRC had raised assessments against the business, but the business went into liquidation, and HMRC then pursued the manager to be as the shadow director of the business. Now, this manager was heavily involved in running the business, although he was not the actual director, but the tribunal concluded that he was the shadow director, and therefore he should be the one that has to pay the penalties if the company is not able to pay. The manager appealed against this decision, but he lost. Finally, one of our own cases, Cora versus HMRC, which we won in February 2019, earlier this year. It was quite a significant win, where a late appeal had been allowed by the tribunal after HMRC refused to allow it. I represented the case in the tribunal. That case has far-reaching implications for other late appeals that have been disallowed by the tribunal. Well-known barrister Keith Gordon has written about this appeal, this tribunal decision, and in the Tax Advisor magazine for July 2019. He's written a 2-page article taking through the steps of how HMRC lost and how the tribunal considered our appeal. If you have time, please have a look at it. If not, you can contact us on 0207 998 1834. Thank you.